Welcome back to Father and Son Investing. Today's video is the December 2023 Treasury Bill update. This video is specific for Treasury bills. I'll address Treasury notes and bonds in a separate video. In today's video, we're going to be talking about what has happened with Treasury bills in the last month and why. Then we'll address what we can expect from Treasury bills. I'll talk to you about what the floor should be, the minimum that the short-term Treasury bills should be reaching. I'll talk to you about some longer-term pressure on Treasury bills as well that might be keeping yields up. Lastly, at the end of this video, I'll give you my strategy for Treasury bill investing for December 2023. So let's get started. All right, this is what has been happening for Treasury bills during the month of November. If you've been following this, then you know that the yields have declined significantly for the month of November. In fact, what I have here in green is what it looked like at the beginning of October, essentially, and then I have here in red the beginning of November, and in blue you'll see what the current rate is as of last Friday, November 24th. In general, all of these yields are going to be down, looking from 1 year back to 1 month. Why has this happened? Well, we won't go into fine detail with this because I'll be looking at it with the bond and note video that I'll be doing shortly. But essentially, there was a lot of economic news that came in that suggested that inflation may be tamed a bit and the economy is slowing. Of course, when that happens, investors start looking for a flight to longer term, wrapping up longer term yields. And so these yields at the end of the Treasury bill curve going out to 1 year have all come down. That's the nutshell for what's happened during the month of November. Let's go ahead and get on to what we could expect for Treasury bills. I mentioned earlier a floor. To me, the floor is going to be right at 5.3% for anything in the 4-month to 3-month and less. Why do I think that's the case? To explain the floor, to explain what I see as the floor, I'm going to show you two graphs side by side. We're going to get into the one on the right even more in a little bit here. But this one shows you what the Fed funds rate has been doing over this course of this year. And we'll see that the current Fed fund rate is at 5.33%. Now, that's important to keep in mind because there's something called an overnight repurchase repo facility. And this graph on the right shows you the amount of money that's kept in this facility. I won't go into the details because I've shown that in some other videos. In fact, I'd encourage you to go back and watch the one for November 2023 Treasury bills where I explain some of this in more detail. But essentially, this money that's kept overnight at the Fed, that money market funds can park their money there, pays them 5.33%. So, after the Congress finally reached their deal on the debt limit, money started flowing from this overnight repo facility where there was approximately $2.3 trillion there at one point in the spring of this year. You can see that this has just been steadily declining. In the last video I showed you, it was down about $1.09 trillion. It's now down into the $890 billion range. So the amount of money that's left there that's been flowing from money market funds into Treasury bills rather than this overnight repo facility is just steadily declining. In fact, the projection is that in the second half of 2024, if things stay the same, that this overnight repo facility will be drawing down close to zero. Why is that? Because currently the money market funds can get a better rate on their money with Treasury bills that are paying 5.4 something percent rather than parking it at the overnight facility where it's only getting 5.33%. However, should Treasury bills move below that 5.33%, well, obviously the money market funds are not going to be purchasing Treasury bills. They're going to go back to the overnight facility. So that's what I see as the floor for really that kind of 3 to 4 month Treasury bill range. Going back to this curve, currently we can see that actually the 1 year is kind of holding steady just above that 5.33% floor. Trying to predict what will happen with that gets much more difficult versus that 3 to 4 month range or even the 6 month range. We see that that 6 month range is still holding steady above that 5.33% floor. The first pressure point is one that I just talked about, this overnight repo facility and the amount of money that is just steadily draining out of there. This money is in general going to Treasury bills because, again, these money market funds can get a better yield on their money in the short term. But there are two pressure points here that could help keep Treasury bill yields up. The first one has to do with the liquidity that's drying up just based on the fact that the shortest Treasury bill is 4 weeks. So if a money market fund purchases a Treasury bill, that money is tied up for 4 weeks unless they elect to sell it. The second reason also addresses liquidity, and that is that this fund here, the overnight repo facility, the money in there is drying up. And as I mentioned, some of the projections are showing the latter half of 2024 or perhaps early 2025, the money in this facility essentially being dried up. The second pressure point has to do with the amount of U.S. government debt that will be maturing over the next 12 months. This graph was actually produced back in September, so it's a little bit old, but it tells us the idea and gives us a volume and just how much debt is going to be maturing. According to the folks at Apollo, 31% of all U.S. debt outstanding, or $7.6 trillion, will mature over the next year. Now, the Treasury has been increasing Treasury bill use in terms of the percentage of all of U.S. debt. In fact, it's projected that it will go up $700 billion more during 2024 and increase from 20% to approximately 22.5%. So if the Treasury is relying on Treasury bills to try to refinance this $7.6 trillion, because of course we don't pay it off, we just refinance it here. So if they're relying on Treasury bills to do that, and the liquidity or the money market fund desire for Treasury bills is going to dry up, that's going to put pressure on Treasury bill yields in order for the Treasury to get them sold. They'll get them sold, but the question is always at what price. The last thing I want to show you, and something I'm really going to start following here, has to do with the net positions of primary dealers when it comes to Treasury bills. If you're not familiar with primary dealers, those are just big institutions, banking facilities that are required to bid on every U.S. Treasury auction. Periodically, these dealers get stuck with a larger percentage of an auction than they were planning on. And so the New York Fed actually keeps track of their net positions. As of November 15th, the primary dealers have almost $52 billion worth of Treasury bills in their possession. And from time to time, this changes. In fact, back in the summer earlier, July 12th, it was about $116 billion that they had in their possession. So this is something to keep track of as well, because if primary dealers get stuck holding a larger portion of a Treasury bill auction than they would otherwise desire, that really dries up some of their liquidity as well and ability to purchase future Treasury bills until they can unload some of the Treasury bills that they're already holding. So in future videos, I'll give this to you in graphic form, but today you just get this little table here. Now let me give you my strategy when it comes to December 2023 for Treasury bills, and that is purchasing the short maturity spectrum, 4 months and less, with a little bit of 1 year. Why? Well, because that 4 month and less is going to have the pressure to keep it above that floor, as I've talked about, and purchasing a little bit of 1 year, knowing that this is a market and Treasury bill yields could come down. If they do, well, then you've locked in that longer yield. If they do go up, well, then you can always purchase some more and volume average up. So that is my strategy. Let me know what your strategy is in the comments. I know this was a short video. I'm sorry it wasn't 12 minutes. Until next time, enjoy your investing.